If you ask 10 traders how they manage risk on a particular trade, at least 7 of them would speak about stop losses. But we all have experienced some serious drawdowns over our trading journey in spite of setting stop losses. It's because we treated stop loss alone as a defense wall, whereas it's merely a brick in the defense wall. Hello traders, and a warm welcome to our channel. Today, we will discuss about a layered risk management approach that we follow at our firm. Before we get in, a disclaimer. The content in this video has been prepared purely for educational purposes only. We are not SEBI registered investment advisors, and the content has been prepared for educational purposes only. The video does not intend to provide any advice or recommendation regarding buy or sell. Trading in financial instruments is subject to market risks. Please consult your financial advisor before making any transaction. Now let's look at the definition of risk. Risk refers to potential loss or harm because of an uncertain event. Now, that loss could be in the form of a financial, physical, or psychological, but for the purpose of this session, we will focus only on financial loss. Now, friends, risk is inherent in every part of life, including trading. Now, while we are on this, a sub to our channel will be totally risk-free. A risk is characterized by two elements. So essentially, risk is a function of two variables, probability and impact. Probability is a likelihood of that uncertain event taking place, and impact is the loss that is caused by the unpleasant or unfavorable event. Now, probability in trading terms can be managed when you're looking at the win rate for a strategy and other aspects that we will cover as part of a separate video. But for the purpose of impact, we will look at how we can structure a layered risk management framework to control the impact of unfavorable market conditions. Now let's look at some of the common mistakes that traders make even when they're trading for quite a while. First, not knowing win rate of a strategy. Now this is very typical to new traders in the market. They usually trade based on an advice that they get from friends or following certain social media handles, and they place a bet whenever there is a recommendation from those channels. However, without knowing the win rate of a strategy, one will not be able to make an informed decision as to how many times the trade should be taken and how to control losses in such a scenario. Not using stop loss at all. Now, if you're like Warren Buffett, you don't need a stop loss because you're not trading security, but you're buying a piece of company, as he likes to put it. But for those of you who are purely trading, not putting a stop loss is like jumping from a plane without parachute. You're going to land very hard. Unwarranted movement of stop loss. Now, what's an unwarranted movement? When you're trading a particular setup, that setup should tell you when to exit the trade because it's going against your intended direction. If you don't exit and move the stop loss further, let's say in case of a long trade, you do move it further down, or in case of a short trade, you move it further up. You're cheating your trade setup, and that is the fastest way you can lose more capital on a single trade. Not planning risk per trade. Now, before you take a trade, you should be planning how much risk you are willing to take per trade. Now, that's a concept that we will discuss in subsequent slides. But if you talk to traders, at least 60% of the traders will tell you that they use a stop loss, but they don't know how much loss that translates into value terms if their stop loss is hit on a particular trade. Large position sizes. Again, in a hurry to make quick buck or following social media channels showing big profits, new traders tend to take positions that are disproportionate to the size of their trading account. And they end up blowing up their capital account if few trades also go wrong. Multiple open positions. Now, even if, let's say, someone sets a stop loss and defines risk per trade, occasionally they find that their trading account faced a substantial setback in a certain period. Reason? Too many open concurrent positions. Have you ever heard of a phrase, death by thousand cuts? Meaning, in spite of not having any significant injury, one dies due to bleeding from thousand small cuts. Too many open positions at the same time and majority of them going wrong could have same impact on your capital account. Now let's look at how to calculate risk. The gross risk is essentially the difference between your entry price and stop loss price multiplied by the position size. Now, for the purpose of covering both long and short type of trades, we have purposely avoided using the words buy price and sell price in the formula. The entry price is essentially the price at which you have entered the trade. So in case of long trades, it is the buy price, and in case of short trades, it is the sell price. Similarly, a stop loss price is the price at which you will exit the trade as per your setup if the trade is going against you. Converse to the entry price, a stop loss price in case of a long trade is the sell price, and in case of a short trade, it is the buy price. And position size is simply the quantity of that instrument which you have either bought or sold, depending on whether it's a long trade or a short trade. Now let's look at the first concept of risk per trade. Uh, Traders usually make a mistake of allocating trading capital to a trade rather than allocating risk capital. What that means is rather than deciding how much amount you want to invest in a particular trade, you should decide on how much amount you want to bet or how much amount are you prepared to lose in case you prove wrong on that particular trade. The recommended value here is not more than 1%, meaning if you're trading with a capital of 1 lakh rupees or 100,000 rupees, you should not take risk of more than 1,000 rupees on a particular trade. Now, 1,000 rupees or 1% might seem too small for most of you, but remember that's the amount that you're prepared to lose and does not mean the position size. The position size will be calculated using this value along with your entry and stop loss price. And even if it's a 1%, it's better to start small, gain confidence in your live trading, gain confidence in your trade setup, and as you prove the success of both models as well as your own live trading, you scale up. As your capital account grows, it will automatically let you take larger positions using the same formula. Second is a monthly budget. Now you might wonder what's budget and how is it relevant in trading context. So along with risk per trade, you also want to set a limit that you want to bet in a particular month. And the recommended value here is 3% of your trading capital. So what it means is at any point of time, you should not take risk more than 3% of your total capital. Now, how is this 3% calculated? Is the sum of risk per trade on all your open positions should not exceed 3% of your capital. Now, Why is this required? Friends, occasionally market will behave in a manner that you did not anticipate. There might be unexpected sell-offs like the one that happened in March 2020. And if you have too many open positions, then even if you have followed the first and second rule of setting a stop loss and setting a limit of risk per trade, if you have too many open positions at a time, your total impact to trading account can still be substantial. For example, if you have taken 1% risk per trade, but if you have 10 different positions open at a time and all of them hit their stop loss because of a large market wide sell off, you are about to lose about 10% of your capital, which is substantial drawdown in a single month. So, if you want to protect your capital, do not open too many concurrent positions. Keep the risk of all open positions under 3% at any point of time. As you gain confidence by trading over time, you can increase this, but for all the beginners, it is recommended not to go beyond 3%. What if you hit that 3% in a month? Suspend trading for the rest of the month. Do not trade. Do not try to trade and win back the money that you've lost. You will lose more. Just suspend the trading for the rest of the month. Take a break. Revisit your setup. Revisit your market conditions. See if you want to make any adjustments and then start afresh from the next month. This will also work from the market perspective, because if market has a volatility in a certain period, it will allow that break will allow the market volatility to subside, because markets are not volatile all the time. That volatility will subside and you can enter when the time is right. Position sizing. Now, again, mistake that most traders make is starting with the position size and following the social media handles. They want to make quick buck, and hence they start with large position sizes. It should be converse. Position size should be the last variable that you calculate before opening a trade. And how do you calculate that? You take the gross risk, that is the risk per trade that you have allocated for that particular trade, not more than 1%, and divide that by the difference between entry price and the stop loss price. So that is essentially the risk per share that you have taken. When you divide the risk per trade by that difference, what you get is a position size. So let's take an example. You're trading with a capital of 1 lakh rupees or 100,000 rupees, and you have allocated 1,000 rupees in line with our rule of 1%. The entry price for that trade is 1,200 rupees, and let's say the stop loss you have set is at 1,100 rupees. So the position size here will be 1,000 rupees, which is the risk, divided by 1,200, which is the entry price, and 1,100, which is the stop loss price. So you can buy 10 units of the instrument for that particular trade. Now let's look at this holistically and see how it helps you protect your capital in a structured fashion. So let's assume this is your capital. We have the first dimension, which is impact, and the second dimension, which is probability. Now, as we saw, probability is a function of the strategy's win rate, as well as few other factors that we will discuss in a different video. The impact can be controlled through risk per trade, which is 1%, and risk per month, which is not more than 3%. Now, using risk per trade, you calculate the position size for the trade, and using risk per month, you decide on how many open positions that you will carry at any point of time. This structural approach will work as a strong defense for your capital. That's all for now, friends. I hope you learned something valuable today. If you liked what we discussed, give a thumbs up and have a profitable and risk managed trading. Thank you.